So let's go through some points real quick. So mortgage rates are determined by the 10-year Treasury bond yield, not directly by the Federal Reserve rates. So when bond yields rise, mortgage rates usually rise. When bond yields drop, rates often follow. Federal Reserve rates impact more short-term borrowing costs and not long-term mortgage rates. Number two, from a historical perspective, interest rates of 3 and 4% during COVID, that was an anomaly. And let's say if you were 250 years old, you would have seen interest rates in the threes once in your lifetime. And that was about 5 years ago. The 100-year average mortgage rate from 1925 to 2025 is about 7 to 8%. So we're on the low end of that. We're in the mid sixes right now on average. And number three, if you're going to wait, that could maybe cost you more. So home prices are still rising in most areas. Even if rates drop a little bit, higher prices can offset any savings you might see from waiting for a lower rate. In many desirable neighborhoods, demand remains strong. Limited inventory means prices are still going to slowly increase. And in the future, if rates do drop, you can go ahead and buy now and refinance then. But if you're waiting and rates drop, then there's going to be more buyers to flood the market, creating bidding wars. Make it harder for you to get into the house that you want because there will be more competition. So basically, it's not tariffs, it's not normal credit card interest rates, it's not just inflation, it's a combination of all those things that lead to what other nations view our national stability economically to be. The Treasury bonds are more tied to the currently, exorbitant, very high national debt that we have. And so the Treasury bonds are more related to what the world thinks of our buying power and our stability as a nation. So that is really what is affecting the mortgage rates.